Hello everyone and welcome to your Glassnode video report for week 18, 2022. So we are clearly hanging in this very delicate balance. We've been in this consolidation range for about 3 months now, and really we're kind of peering off into the edge being like, are we going to capitulate? Does the market really need to flush everybody out? We've talked about over the last couple of weeks how we've seen this long and short-term holder capitulation. So really what we want to explore here is what is the risk profile? What would that look like? And can we start to assess this from a fundamental pricing model perspective and look at a number of metrics that we've developed over the years in this field to really assess what does a bear market floor start to look like? So we are kind of looking at this edge of profitability. We're going to explore just how profitable the market is. We have this nice confluence between addresses, entities, and supply that are all telling us a fairly similar perspective in terms of how much of the market is in the green. And we also have past cycles to look at what is a reasonable pain threshold that we may need to get to actually trigger and therefore signal that a bottom is in. Now, we're also going to explore in a bit more detail this concept of the long-term holder capitulation and really explore this specific cohort and actually assess what kind of age range are we talking about. Are we talking about long-term holders from last cycle, or are we talking about long-term holders who've only been here for 6 or 7 months, kind of the newest folks to the party? And what we're going to explore is this toolkit of things we can use to really navigate these latest stages of a bear market and really understand when things are starting to get to that value, undervalued, or overvalued level. As always, just before we get started, please do give us a like and a subscribe. It really does help this channel. We've just crossed our 51,000 subscribers, so thank you everyone who continues to watch these videos. We really do appreciate it and just want to give you a really big thanks. Let's get started. Okay, so here we are in our week 18, peering into the Abyss dashboard. You will find a link to this in the description below if you do want to follow along. And you can see that, we've talked about this consolidation, this bear flag, whatever we want to call it, that we have been in for more than 3 months. We've now been inside this consolidation phase for a longer period of time than the correction to get us down here. So it's starting to feel like we've been here for quite some time. This is kind of what our recent history is. And we've seen the accumulation that's been hot and cold all through this process. Quite impressively, we continue to hold this level, even though correlations to traditional markets and the risks and uncertainties within that remain very high. So in a way, Bitcoin and the cryptocurrency market continues to be almost at the whim of some of these traditional finance markets. But overall, one thing that I've certainly noticed is that we broke to new lows on the SPX and the NASDAQ, but we broke back into the range for Bitcoin. We actually didn't set a new local low within this consolidation framework. So in a strange way, Bitcoin's actually holding up in a surprisingly robust sense. So we're going to explore this in a little bit more detail and just try and understand these risks. But what we're going into this session in particular with a view on is that we are kind of peering off into what could be further downside. And really it's about preparing us, understanding what the scale of that could look like, and how we kind of assess what price ranges start to look like value, what price ranges start to actually look like we've got those fundamental metrics telling us that the market may be starting to turn the tide. So the first thing that I want to start on is these 3 metrics here. So we have our percent of addresses, entities, and supply in profit. And what you can see is that they all kind of look like a very similar picture, right? They're all, in general, they have this top level, which makes sense. You're at 100% of addresses, entities, and supply in profit. That's always going to be an upper bound constraint, and we naturally see that during bull markets. Now, the second thing we can note is that there's a rising floor on all of these. It's kind of this big ascending triangle. Now, this makes sense because over time, there's going to be more of these addresses from the Satoshi era, from the early miners, whether it's addresses, whether it's entities or supply, all of these things are going to move into more profit because of lost coins and things that just simply haven't moved. So there's going to be a natural tendency for these to all move upwards. Now, in the actual week on chain report, we actually plot all of these over the top of each other inside a workbench, and you can see that over recent history, they've really collapsed. We get very similar readings. All of these are currently sitting around 75, 72, 70% of the network is currently in profit. Now, what I want to highlight is let's take recent history. We don't particularly care so much about the 2012 or the 2015. That was kind of old history. Let's look at the 2018, the 2020, and our current bear cycle. And what we can see is that in previous cycles, we had 45%, we had 50%. Here we are at 75%. So we can kind of see that there is this upwards trend. So we don't necessarily expect our profitability to drop down to say 45% or even 50%. But maybe at our 75% or 72% level, let's just take into account what would happen if we dropped an additional 10%. So what this means is that 10% of addresses, 10% of entities, and 10% of the supply who are currently in profit suddenly turn into a loss. Price drops enough. Let's just take supply as our base case here. What price would we need to fall down to in order for an additional 10% of the supply to be now at an unrealized loss? So that's kind of our analysis case study. We're going to use this and actually explore what it would take in order to create that risk profile, which in a way is kind of the same pain threshold that we were at March 2020, whilst also accounting for this longer term kind of uptrend in all of these metrics. And that's where we're going to turn to our URPD. This is looking at the price at which every single coin, so the bar height is how many BTC moved in that particular price bucket. And what we can basically see is if we take that 10% supply, we just passed 19 million coins, so 10% is about 1.9 million BTC. So what price? We're currently sitting here at 38,500. What would need to happen for price to fall and put an additional 1.9 million BTC into a loss? And of course, this assumes no spending, but let's keep our model simple for now. So in fact, if we calculate this out, if we sum up the height of all of these bars, we have 760,000. I mean, look how large this bar is. There's a huge amount of accumulation that's gone. We've talked about this within our current price range. This 38 to 42,000 realm has been a heavy period of consolidation, a heavy period of accumulation. So if prices drop below that, naturally, a huge portion of the supply is going to move at a loss. Now, if we take this 760,000, this one here, which is 275,000, this one here, 241, and we keep adding them up until we get down to our total of 1.9 million, that actually puts price down here about 33,000. So what that's telling us is that if prices fell down to 33,000, which is also the bottom of our current price range, that's where we hit back there in January, then we would hit a similar amount of pain threshold to what we've seen at the bottom of previous bear markets. Now, remember, this is not telling us that we're going to go to 33,000. It's also not telling us that 33,000 will be the bottom. But what it's telling us is that that is a similar level of pain that the market has been in as previous cycles. So we're starting to just build up some of these tools to try and help navigate what this later stage of the bear may look like. So we're never going to know these things in advance. Nobody can tell the future, but we can use these things to build up a risk profile to just understand what could happen. So now we're going to move and actually look at the short and long-term holder behavior. We've been talking about this long-term and short-term capitulation over the last couple of weeks. Let's actually jump into some full-scale charts. And here we go. Team Dark Mode wins on this front. So we're going to start with our short-term holder. Remember, this is the cohort of people who there's two things I want to take away from this. The first one is that short-term holders have accumulated a huge amount of supply. We explored this a lot in week 16. During our current consolidation range, they own an enormous amount of that supply. So of that 1.9 million holders, a lot of them are going to be short-term holders. If we saw those coins go into a loss, a lot of them are short-term holders. And the second thing is that this is the most likely candidate to actually sell. They're the most reactive to price. Now, the metric that we have here, we have two different traces. We're going to start with the price chart. This one here is our short-term holder realized price. It's the average price that every short-term holder paid for their coins. And what you can see is in 2018, it provided resistance the whole way down. These are short-term holders selling to just get their money back, get me out at any price. It's going to get my money back. So it acts as resistance during a bear. During the 2017 bull, it provided support all the way up as people buy what they previously saw was their cost basis. We saw this same behavior again in the 2020 and 2021 phase. As we fall down below it, this is where we see short-term holders are in financial pain and they start to distribute their coins. And you can see we've essentially been underneath this level since December 4th. We had that capitulation event where we had a huge flush out of leverage on December 4th, and we've essentially been underneath it ever since. Now, what we then do is we take the difference between our price and the short-term holder cost basis. So when it's much higher, they're in a lot of unrealized profit. When it's very far below, they're in a lot of unrealized loss. This is not spending. This is the coins that short-term holders currently own. How much of a loss are they currently in? So you've got a bunch of coins in there, you bought them at 40,000, you're in a certain amount of loss right now. On average, short-term holders are about 18% of a loss on all of their coins as we speak. And this is what this oscillator is showing. Negative values means that they're holding a lot of underwater coins. Higher values means they're holding a lot of above water. They're in a higher degree of profit. And you can see where we are at the moment. We're actually, we've been lower. We've been lower, but it's normally lower at the very bottom of these corrections, at the very bottom of these capitulations, at the bottom of March 2020. So we're in a pretty grim situation. You can see we've been in this situation for some time. The 33,000 bottom was pretty bad. It's getting down into March 2020 and November 2018 type levels. We're not there right now, but if we got that 10% move, it really would start to look like March 2020. So again, we're kind of mapping at this second layer of what could be that capitulation potential. So again, it's kind of adding a bit of weight to that 10% observation of a pain threshold that would be equivalent to previous cycles. Now, moving along to the long-term holder cohort. Remember, these are folks who've held their coins for 155 days, about 5 months. Now, there's a bit of a misconception. Just because they've held their coins that long, and just because they are long-term holders, doesn't mean that they're not going to sell in the face of some kind of financial pain. We're all human, and we all react to these things. Now, I have 2 metrics plotted out here. In blue is the long-term holder cost basis. So that's the same. It's the average price paid for all of their coins. I'm actually going to zoom right in on our current market cycle because this is really where we want to focus today. So that's their cost basis, the average price that they paid for their coins. Now, the pink price is the price. Imagine all the long-term holders spending today. What's the average price that they purchased at? Now, it's kind of what I call their spent price. This is the price where long-term holders are spending from. And you can see that most of the time it trades somewhere above because all of these long-term holders, this includes all of the guys from previous cycles and even 2 cycles ago. So the average cost basis is much, much lower, but the amount of spending it's higher than that, but it's typically lower than price because people are spending, some of them from $6,000, some of them from 20, some of them are from 50. So it's this kind of average of prices and it's much higher than the total cost basis. But what is the most fascinating, in fact, let's zoom in just even a little bit more. Look at this massive divergence. We've talked about this. The long-term holder realized price is declining. This is the largest rate in history. We've talked about this in week 16. If you haven't seen week 16, I would recommend you go back and review that particular video. This one here is looking at a capitulation. We are seeing long-term holders from the 2021 and 2022 cycle leaving the system. And that means that all the people who are left are from previous cycles with a much, much lower cost basis. That's the only way we can get this absolute waterfall of the average price paid. Now, to support this observation, look how the pink line is actually curling upwards and is pretty much at price right now. This is showing that most of the long-term holders who are currently spending have an average cost basis of almost $38,000, very similar to our current price. Long-term holders, this collapsing up to the price chart is showing long-term holders are selling to get their money back. They're panicking. They're actually capitulating. And most importantly, those who are capitulating are from the recent cycle. That's the only way that this metric can be climbing at the same time as this metric declining. It shows that long-term holders from the 2021 and 2022 cycle, people who purchased inside this realm, are currently spending because they're afraid, they're fearful of downside, they're providing that overhead supply and they're exiting the system, selling to short-term holders, and now this kind of cycle has to start again. Do these short-term holders have the grit to sit through any downtrend? Are they going to create additional sell side? We've almost reset the ownership structure and we have to start reassessing it from a short-term holder basis. They become the ones who drive price action as we move forward because lots of these long-term holders have now exited the system. So now we're going to get into kind of navigating this bear market bottom. And I've got a couple of metrics here. These are, to be honest, these are some of my favorite metrics to track, particularly at this stage of the cycle. So the first one is our realized profit and realized loss. And I just want to jump into the full screen view of these. So what I really want to highlight here with our realized profit and our realized loss, these two metrics work very well in tandem. They tell two different stories. Now, the first story, we're going to look at three different market cycles here to help navigate this bear market low. So the first one is that a bull market stands out clear as day. You can see 2017 and you can see 2021 and these two little blips here in 2019 and a very similar rally that we had here in this August through to November period. So they stand out because realized profits scream higher. People are able to realize profits and the market continues to absorb it. This is the definition of a bull. We have an influx of demand. People can sell their coins at a profit, exit from the market, smart money leaves, new money comes in, and eventually we get the blow off top. Now, after that blow off top, look how quickly realized profits decline, and we move into a regime where our realized losses start to take over. And you can see through 2017, note how we can barely see any of the profits. It's pretty much entirely loss dominated for this entire 2018 all the way into the 2019 phase. Same as where we currently are. We've kind of had this descent into the bear. We had our blip similar to 2019 of this kind of emergence of profit taking, but it wasn't enough. The market just rolled over again and we moved back into this primarily loss-making regime. So where we currently stand is very similar to 2018, where losses are dominating the spending behavior. We've got little bursts of profit, but it's really not enough for the market to sustain. Now, what we then move into, note 2019 was this kind of blip of profit taking, realized losses took back over, and then March 2020 happened. Major capitulation event, huge losses realized. And on the back end of that, look, realized profits start to emerge as the dominant trend. They didn't explode until we got here to this October rally, but we saw that realized profits started to come back into the mix. The market traded sideways to up, and that's showing demand was there to absorb profits. So what we really want to pay attention to is, do these losses start to decline? And do we start to get a dominance of profit taking start to come in and the market can absorb it? That would be our first signal that we may be moving into that transitionary phase. And remember, this took months, right? We had our March 2020 event, and it wasn't really until October later that year that we saw the explosion into the full-scale bull. So this thing takes time, but that's what I'm paying attention to, this transition from purely loss dominance into moving into a more profit-dominated, but overall trending sideways to upwards market. This is the first sign that we can pay attention to. Now back to our dashboard, this is where we're going to look at a number of these valuation models. These help us try and map out the bottom of the bear. Now, one of my absolute favorite metrics, and it is metric of the week, if there's one tool that I want you to take away from this, it is the Mayer multiple. It's not even an on-chain metric. It is just the simple ratio of the 200-day moving average to price. Now, the reason that this metric is so powerful is because traders, technical analysts, on-chain analysts, people who go back as far as trading markets have been around, people have focused on the 200-day moving average as this bull-bear bias. And it's kind of got this natural rhythm that so many traders pay attention to it that it typically becomes a bit of a self-fulfilling prophecy. When below the 200-day, generally bearish. When above, generally bullish. Many large capital allocators won't pay attention to an asset until it is above the 200-day moving average. So what we see here is this oscillator typically hits these peaks fairly consistently around 2.4 at bull market highs. And note that it doesn't spend that much time below. There's only a handful of instances, typically at the bottom of absolute bear markets, kind of when the absolute worst is in play. And also note that in 2018, we had this first reaction into this undervalued zone. We bounced, and then we came back and revisited. In 2019, we had this initial reaction as we came into 2020, we bounced, and then March 2020 revisited. Here we are in our current cycle. We collapsed in May, June, July. This was our first instance. We bounce, and here we are revisiting. They typically come in these sets of twos. It's that initial flush out as we enter the bear. There's a bit of a relief rally. People start to get their hopes back in, and then we collapse back down under. Now, that doesn't mean that we're necessarily at this point where we have to bounce from here, but we are at this level. This is the 0.8 level. That means that we're trading at a 20% discount to the 200-day moving average. And for a bit of probability, we've only Bitcoin's all history. We've only been under this level for 15%. So of all the trading days in Bitcoin's history, The Mayer multiple has been 0.8 or less for only 15% of the time. So that means that 85% of the time we've been higher than that. So we're starting to get a bit of a probability that this doesn't happen very often. We can stay down here for some time, 15% of Bitcoin's life. But it also means that we're getting down to that kind of floor level where over time, we're starting to see that there's a probability associated with these somewhat undervalued levels. Now, one important caveat, the 200-day is a moving target. So if we spend a lot of time down here, the 200-day will also start to descend, which is why you can see we spend some months, all of the 2018, this was 4 months, we were quite some distance below the Mayer multiple. So it is a tool, but it's not the only tool. Now, the next one we have is our reserve risk, and we do have a video guide on this one. I would recommend you jump in and have a look at that one. If you haven't seen it yet, you'll find that our Onchain 101's playlist. But what we have here is this metric is really governed by hodlers. When there's lots of hodling, this metric gets pulled downwards. And you can see that we are now firmly inside the green zone. Now, the reserve risk typically enters the green zone in the late stage bear, but not at the end. We still have some time to go. This took another 1.5 years to fully play out in 2015. We entered this one on November 2018, and then we had all of 2019 and 2020. So we can be in this green zone for a very long time. But the reserve risk typically enters late stage bear, and it leaves halfway through the bull, right? Before we had that October rally and before we entered the 2017 rally. So the reserve risk will stay undervalued for a very long period of time. Late stage bear typically exits towards the back end or the middle of the bull. So it kind of gives you that very long-term roadmap. Now, the value days destroyed multiple. This is one of TXMC's creations, so props to him. What this is looking at the amount of coin day destruction times price and compares it to the last year. Are we seeing lots of these old coins come back, realizing a profit or a loss relative to the last year or not? Now, this metric tends to enter this kind of undervalued green zone very early in the bear. So it's kind of an early metric to signal that we're entering bearish territory, and it typically exits somewhere near the start of the bull. So you kind of capture the early bull phase as people start to realize profits and bring their old coins back to life. We saw this again in 2018. We entered very, very early in the bear. It was a quick signal to tell us that things weren't quite right. And we traded down that level until the 2019 rush. We had a slight spurt above, and then we returned back to this zone, only to kick back out just before, after our March 2020 event, we had a bit of a recovery, and then we started to get that profit taking. Now, we entered this metric back here in May, which again signals that we entered that bear as far back as May. We had our little all-time high revisit, and we are still back down in this zone. So we haven't yet seen the recovery yet, which means we're not kind of at the end of the bull at this point in time. But again, this is another metric we can use to kind of map out where we are in the cycle. Now, the last metric just to close on is our RVT ratio. This takes the ratio between the realized cap, which is kind of the on-chain market cap, and the amount of transaction volume. Now, this metric has 3 key interpretations. Uptrends means that we're generally getting increasingly bearish. We see this in bear markets. It means that the market value is much larger relative to the transaction value. The valuation is high relative to utility. So we get these uptrends and high values. We generally get these sideways periods during what I call a sustainable period. Now, this can be bearish. If we're at the top level here, it means that the current bearish trend is sustainable. We deserve to be in a bear, and typically the market will continue. And we also see this in a bull market. Note here in 2016, this trades sideways, which is showing that the market cap or the realized cap is rising at an equivalent rate to transaction volume. We're justified in our current trend. The bull market is sustainable because valuation is rising at the same rate as utility. We've got this equilibrium. We're in balance. The current trend makes sense. And you'll see that when we get that break of trend back into an uptrend like we did here in 2018 and like we did here in 2019 and 2020, we can see that that's kind of that signaling that maybe we're now getting overvalued. And the last one to pay attention to is a downtrend. Now, these can take a process that it's not the cleanest of signals, but what we're looking for is this downtrend to initiate, because the same way that an uptrend means that value is too high relative to utility, well, a downtrend is the exact opposite. Utility is growing. More people are moving and settling value than the overall market cap or realized cap is suggesting. So a downtrend is typically a constructive sign. And you can see that this happens during bear market bottoms. We're trading sideways, the market thinks Bitcoin is dead, but under the surface, more people are settling transaction volumes. So let's zoom into our current market cycle. We've seen this burst of activity, this high level of value back here in July. This was signaling that overall the market was massively overvalued. We had this bearish correction. Now, where we're at the moment, we've set a lower high. Remember, downtrends are good. Downtrends are constructive. We've set this lower high here during our current consolidation, and we are breaking lower. So this is showing that transaction activity, settlement activity is actually getting a little bit more constructive relative to the realized cap. We do have improving fundamentals, even though price is not really telling us that story. Now, we've still got some way to go, but overall, we've got this picture here between our Mayer multiple, which is at a relatively low value, the reserve risk, which is telling us we're getting into the late stage of the bear. We're not done yet, but we're late stage. Our value days multiple is firmly within bear territory, but it's not at the beginning. So we've gone through a lot of the pain already, and we've got improving fundamentals on the transaction activity. So here's 5 different metrics, realized profit and loss, and these 4 on the screen to help us navigate the next couple of months as we process where will the market go from here. So thanks for tuning in for that session, folks. As I mentioned, we're in this kind of delicate equilibrium, and we need to just have that risk model, that 10% risk model, in case we have further downside risk. And remember, we could fall more than 33,000, but we're just trying to bound the problem and trying to assess these probabilities based on previous cycle pain thresholds. And we do have a suite of metrics that are helping us navigate these bear market floors. They can be challenging, it can take time, but what we really need to do is just try and track these things as best we can and try and find confluence between multiple metrics that are all telling us that we have a consistent story and consistent fundamentals growing underneath. So thanks as always for tuning in. Thank you for watching these videos, and I look forward to seeing you in the next one. Cheers.